All right, today we're going to do something pretty cool. We're going to connect a pattern that you literally see everywhere, from a crowd of people to your kid's report card to a single powerful number that helps giant banks and investors figure out what's at stake. Let's dive in.
So let's start with a really big and kind of tricky question. How can we possibly measure the future? I mean, trying to predict what might happen, especially when it comes to money, feels like trying to solve an impossible puzzle. But it turns out the first clue is hiding in plain sight, all around us.
Just think about it. Picture a big crowd of people. Yeah, you're going to have some really tall folks and some really short folks, but most people, they're going to be somewhere around that average height, right?
Or hey, how about this one? The scores on a big final exam. You'll have a few geniuses who ace it and a few people who really struggled, but the vast majority of scores are all going to be bunched up right there in the middle.
See what's happening here? This tendency for things to cluster around an average, it creates this super familiar shape. And that shape, well, that's the key to solving our entire puzzle about predicting the future.
Yep, you guessed it. That shape is the famous bell curve, or if you want to get technical, what statisticians call the normal distribution. The best way to think about it is like a visual map of probability. It shows us what's likely, what's a little less likely, and what's, well, pretty rare.
So just look at it. That high point right in the middle, that's your average, your mean, that's the most common, most probable outcome. And as you move away from that center in either direction, the curve gets lower and lower. That just means those outcomes get less and less likely to happen. And notice, it's perfectly symmetrical.
And you know what's crazy? This whole map of possibilities, this entire curve, it's really just defined by two simple things. Where the center is, that's the mean, and how wide or skinny the curve is. That's its spread, which we measure with something called standard deviation.
Okay, so let's zoom in on that second idea, the spread. Standard deviation is basically the ruler we use to measure how spread out everything is. It gives us a consistent way to talk about how far any single data point is from that average in the middle.
So here's the rule of thumb. For pretty much any normal bell curve, about 68%, so more than 2/3, of everything is going to fall within one ruler length, or one standard deviation, of the average. If the average exam score was an 80 and the standard deviation was 5 points, that means about 68% of the class scored between a 75 and an 85.
Now, what if we go out a little further? Let's say 2 ruler lengths, 2 standard deviations from the middle. Well, now we've captured a whopping 95% of all the possible outcomes. So in that same class, 95% of students scored somewhere between a 70 and a 90.
And if you go all the way out to 3 standard deviations, well, you've basically got the whole shebang. We're talking 99.7% of pretty much everything that could happen. Anything outside of that is a real outlier. I mean, it's possible, but it is really, really unlikely.
All right, this is all pretty neat, right? A cool pattern in nature and in classrooms. But you're probably thinking, okay, fun with statistics, but what on earth does a bell curve for student grades have to do with the stock market? How do we actually take this idea and use it to measure real financial risk?
Well, this is where it gets really interesting. The answer comes in the form of a tool called value at risk, or as everyone in finance calls it, VAR. This is where that abstract bell curve gets its hands dirty in the real world.
What VAR does is it just cuts through all the noise, all the complex charts and jargon to answer one simple but absolutely critical question. On a normal day, how bad can things really get?
So to put it simply, VAR is all about giving you a single number that estimates how much you could lose. And it always comes with 3 key parts: an amount of money, a specific time frame, like a day or a week, and a probability level.
Now, you might think calculating this sounds super complicated, like some kind of Wall Street wizardry. But honestly, it's more like a recipe, and it's only got 3 main ingredients.
Okay, ingredient number 1. How much skin do you have in the game? That's your position size. Number 2, how much does the investment tend to wiggle around on a given day? That's its volatility, which, hey, that's just our old friend standard deviation. And finally, number 3, how sure do you want to be about your prediction? That's your confidence level. 95%, 99%, you get to choose.
Okay, let's put this recipe into practice so it's not just a bunch of theory. Let's say you've got a $10 million investment in Microsoft stock, and you know from history that its daily volatility, its standard deviation, is about 2%. And you decide you want to be 99% confident in your risk estimate. You combine those three ingredients and boom, you can calculate a single VAR number that sums up your risk for tomorrow.
Okay, this all sounds great, almost too great. And there is a catch, a huge one actually. This entire beautiful mathematical system rests on one giant assumption, one big if that separates the perfect world of models from the messy reality of the market.
Here's the thing. The model assumes the market behaves perfectly, like it's always following that clean, predictable bell curve. But we all know the real world is messy, right? Financial panics, wars, surprise announcements, these things can cause crazy outcomes that happen way more often than a perfect bell curve would ever predict. The model works great until the day it doesn't.
So you might be asking, if it's not perfect, why the heck are we even using it? Well, because its real power is actually in its simplicity. VAR takes this huge, scary, complicated concept, financial risk, and it boils it all down to a single number that people can actually understand and talk about. It gives everyone a common language for risk.
And that brings us right back to the beginning. We can finally decode that kind of statement. If a bank says their one-day VAR is $1 million at 99% confidence, you now know exactly what that means. It means, under normal conditions, we are 99% sure we won't lose more than $1 million tomorrow. But it also means they know there's a 1% chance they could lose more than that, a lot more.
So I'll leave you with a question to chew on. That 1% chance of a disaster feels small, doesn't it? But think about it this way. When a weather model predicts a 1 in a 100-year flood, it doesn't mean you're safe for the next 99 years once it happens. It means there's a 1% chance of it happening this year, and another 1% chance of it happening again next year. It's a pretty sobering way to think about what that tiny little percentage of risk actually means.